Bitcoin, the quiet threshold most people will never reach late at night, somewhere between scrolling and sleeping. A lot of people do a version of the same calculation. They look at the price of Bitcoin, they look at the bank account, and then they feel something uncomfortable. A mix of regret, confusion, and the quiet fear that they'd already missed something important. Maybe you've been there, maybe you're there right now. And here's what usually happens next. The price feels too high to take seriously, so instead of thinking clearly, people start looking for shortcuts. Cheaper coins, faster gains, something that feels more accessible, something where the number in their wallet looks bigger. It's a completely human reaction, and it's also, quietly, one of the most expensive financial mistakes a person can make. Today, we're going to talk about something most finance content never addresses honestly. Not whether Bitcoin goes up or down, not which coin to buy, not how to get rich quickly, but rather a specific threshold that changes how you think about money, about saving, and about your relationship with the financial system itself. That threshold is 0.1 Bitcoin, not one full coin, not 10, not $1,000 of some speculative token. Just 0.1 Bitcoin. And why, for the average person trying to build real financial awareness in today's world? This particular number carries a meaning that goes far beyond its price tag. My name is AR, and this is AR Investor. Let's work through this carefully, because there's a lot to understand here, and understanding it clearly is what actually matters. Before we talk about Bitcoin specifically, we need to talk about your brain. Because the way human beings are wired to think about numbers is, in many financial situations, completely counterproductive. There's a well-documented psychological phenomenon called unit bias. In simple terms, it means our brains feel more satisfied owning a large quantity of something than a small quantity, even when the actual value is identical or even reversed. Here's a simple illustration. Imagine you're at a market and someone offers you two options. Option A is one small jar of rare aged honey worth $80. Option B is 10 jars of ordinary honey worth $8 combined. Logically, option A is clearly more valuable. But psychologically, many people feel more satisfied with 10 jars. More feels like more. The unit count triggers a sense of abundance, even when the underlying reality is the opposite. Now bring that same mental wiring into a financial decision about something like Bitcoin at $70,000 per coin. A person with $500 to invest does the math. They could buy roughly 0.77 Bitcoin. That number looks and feels small. It feels inadequate. It looks like failure before they've even started. Now compare that to a different asset, one priced at a fraction of a cent, where that same $500 could buy millions of units. Suddenly, the number feels enormous. The person feels like a serious investor. They feel like they're holding something significant. But here's the critical question. What are they actually holding? In most cases, when people chase low-priced assets purely because the unit count feels better, they're not making a financial decision. They're making a psychological one. And those two things are very different. The asset's price per unit has no inherent relationship to its quality, its potential, or its underlying value. A stock priced at $1 is not inherently better than a stock priced at $500. A token priced at a tiny fraction of a cent is not inherently more likely to appreciate than something priced at $70,000. What matters is the underlying fundamentals, the supply structure, the adoption, the history, the use case, the network, the institutional backing, the protocol. Unit count is a psychological comfort, not a financial metric. And yet, when people feel priced out of something they've heard about, unit bias kicks in almost automatically. It's not stupidity, it's evolution. Our brains were wired to count resources to prefer abundance over scarcity in immediate terms. That made perfect sense when the resource was food or firewood. It makes much less sense when the resource is a financial asset with a fixed supply. Understanding this bias doesn't make you immune to it, but naming it clearly, seeing it for what it is the first step toward making decisions that are based on reality rather than perception. Now let's talk about Bitcoin's supply structure, because this is where the educational value becomes genuinely interesting, and where a lot of casual observers miss something fundamental. Bitcoin was designed with a hard cap. There will only ever be 21 million Bitcoin in existence. This isn't a policy that can be changed by a board of directors. It isn't subject to government override or corporate decision-making. It's written into the protocol itself, a mathematical limit enforced by thousands of independent computers running the same code around the world. As of early 2026, approximately 19.85 million Bitcoin have already been mined. That leaves just over 1 million yet to enter circulation, and those will be released slowly in decreasing amounts over the next century or so. Here's where the math becomes worth sitting with for a moment. Of those approximately 19.85 million mined coins, a significant portion, researchers estimate somewhere between 3 and 4 million are effectively gone, not in circulation, not accessible, lost to forgotten passwords, misplaced hard drives, deceased owners with no recovery plan, and wallets that simply cannot be accessed. These aren't hypothetical stories. There are documented cases of individuals who hold access to tens of thousands of Bitcoin and cannot retrieve them because they've forgotten the password. There are hard drives sitting in landfills containing significant amounts of Bitcoin that were discarded before their value was recognized. Every one of those coins is effectively removed from the available supply permanently. So when you account for lost coins, the realistic circulating supply of Bitcoin is likely somewhere between 16 and 17.5 million coins. Not 21 million, not 19 million, significantly less. Now consider this alongside population. There are roughly 8 billion people on Earth. If you divide 17 million Bitcoin by 8 billion people, you get approximately 0.02 Bitcoin per person, assuming perfectly equal distribution, which of course will never happen. What that number tells you is this: 0.1 Bitcoin represents roughly 50 times more than what would theoretically be available per person if supply were evenly shared. That's not a reason to make any particular financial decision, but it is a reason to understand what you're looking at when you evaluate this asset class. Scarcity, historically, has had a relationship with value across many different asset types, from real estate in dense cities to rare commodities to collectibles. The scarcity here is mathematical and permanent, and it's tightening in another way as well. Over the past several years, large institutional investors have moved meaningfully into Bitcoin. Asset management firms, publicly traded companies, and even some national governments have begun holding Bitcoin as part of their treasury strategy. This is a structural shift from even 5 years ago, when Bitcoin was viewed almost exclusively as a retail speculation. When large institutions accumulate an asset with a fixed supply, they reduce the amount available for everyone else. Supply gets absorbed. The pool of accessible coins for ordinary individuals becomes smaller over time, not larger. This doesn't mean prices will move in any particular direction at any particular time. Markets are complex and unpredictable. But it does mean the structural context is meaningfully different today than it was in prior cycles. Understanding this context helps you think more clearly about why a specific threshold like 0.1 Bitcoin carries significance that isn't immediately obvious from the price tag alone. Now let's ground this in something more relatable than math. Most people who feel priced out of Bitcoin don't simply walk away and invest elsewhere. What typically happens is they look for alternatives that feel more accessible, and they find them in abundance in the cryptocurrency space. The ecosystem of speculative tokens is enormous. There are thousands of coins, tokens, and projects that trade at fractions of a cent. Many of them are promoted aggressively through social media, messaging platforms, and influencer culture. They promise large returns. They have memorable names. They create communities around shared optimism. And some of them do, in fact, generate extraordinary short-term returns for a small number of early holders. That part is true. It happens. And is precisely why the trap is so effective. But here's the fuller picture. The part that often doesn't make it into the promotional content. When you look at any extended market cycle and examine how speculative tokens perform over that full period, not just at their peak, but from start to wherever they end up, the overwhelming pattern is underperformance relative to Bitcoin. Not slight underperformance, dramatic underperformance. Many of these tokens lose 90%, 95%, or even 100% of their value between cycles. Many never recover. The stories that get shared are about the rare winners, the coins that went up 100 times, the early buyer who turns small money into large money. These stories are real and they spread because they're remarkable. What doesn't spread is the much larger set of stories. The people who bought at the peak, or held through the decline, or got caught in a project that simply disappeared. This isn't a cynical view of the space. It's just an honest statistical reality. When you invest in a highly speculative, unproven asset primarily because the unit price is low, you're not investing, you're gambling with real money. And the odds in that game are, for most participants, not favorable. The comparison that matters here isn't between Bitcoin and other speculative tokens. It's between a strategy based on clear thinking and patience versus a strategy based on psychological comfort and hopeful math. One of those strategies has a multi-decade track record, the other largely doesn't. Here's something that rarely gets discussed in financial content, but which may actually be the most important aspect of what we're exploring today. Building toward a meaningful financial threshold, any meaningful financial threshold, changes you. Not the number. You. When you commit to a consistent savings and investment strategy over an extended period, something shifts in how you process financial decisions. It starts gradually and then becomes more pronounced over time. Initially, when someone begins regularly investing in Bitcoin through small, automated purchases, they tend to watch the price closely. Every movement feels significant. A 10% drop feels like a crisis. A 10% gain feels like confirmation. The emotional volatility of the price gets internalized. But here's what typically happens if someone maintains the discipline for several months. They stop reacting to daily price movements. Not because they stop caring about their money, but because they begin to understand through direct experience that the daily fluctuations are noise. The pattern becomes clear. They're buying consistently, they're accumulating over time, and the short-term volatility doesn't change the underlying fundamentals. That shift from reactive to patient is enormously valuable, and it doesn't stay contained to one asset. People who develop genuine financial discipline in one area tend to apply that same thinking to other areas of their financial life. They start looking at discretionary spending differently, not with guilt or deprivation, but with a new sense of opportunity cost, the understanding that every dollar spent on one thing is a dollar not available for something else. This isn't about extreme frugality or lifestyle sacrifice. It's about consciousness. It's about making spending decisions deliberately rather than automatically, and over time, that consciousness compounds. The person who develops patience around investment also tends to build an emergency fund they didn't have before. They tend to reduce high-interest debt more systematically. They tend to think in longer time horizons, not just months but years and decades. Financial education content often focuses on strategies, tools, and market analysis. Those things matter. But the deeper value of a long-term investment discipline isn't the returns, it's what it does to your relationship with money itself. That's the transformation that actually changes outcomes. Reaching 0.1 Bitcoin isn't the endpoint of that transformation. It's a milestone within it. A proof point, evidence that you can commit to something, maintain discipline through difficulty, and see it through. That's more valuable than the dollar amount of the holding itself. Let's be practical now. Because understanding the concepts is one thing, actually building toward a goal is another. At current price levels, 0.1 Bitcoin represents a meaningful financial commitment. It's not trivial. For most people, it requires a real plan and real consistency over time. The approach that tends to work best for ordinary investors, not traders, not institutions, but people with regular income and regular lives, is called dollar cost averaging. The concept is simple. Instead of trying to identify the perfect moment to buy a large amount, you buy a fixed dollar amount at regular intervals regardless of price. Every week, or every 2 weeks, or every month. Whatever interval matches your budget and your pay schedule. Here's why this approach tends to work well in practice, especially for volatile assets. When prices are high, your fixed dollar amount buys fewer units. When prices are low, your fixed dollar amount buys more units. Over time, this naturally results in an average purchase price that reflects the full range of the market rather than just its highs. More importantly, it removes the psychological pressure of trying to time the market. You're not making a discretionary decision every week about whether now is the right moment. The decision is already made. The purchase happens automatically. This matters enormously because emotional decision-making is where most investors lose money. They buy when sentiment is high and prices are elevated. They sell when sentiment is low and prices have declined. That pattern, repeated across multiple cycles, erodes returns dramatically. Automation removes that weakness. The purchase happens at the schedule you set, independent of how you're feeling about the market that particular week. In terms of what the journey looks like practically, consider a simple example. Someone begins investing $100 per week in Bitcoin. Over 52 weeks, that's $5,200 invested. Depending on where prices move during that year, the value of the accumulation might be above or below that number at any given point. But here's what's also true after 52 weeks of consistent investing. They've demonstrated discipline, built a habit, reduced emotional reactivity, and created a financial asset they didn't have before. Those outcomes are certain regardless of where the price goes. The goal of 0.1 Bitcoin, approached this way, becomes less about timing and more about persistence. It becomes a demonstration to yourself that you can build something over time. This section is important. Any responsible financial education must address both possibilities clearly, not just the optimistic scenario. The case for long-term optimism around Bitcoin's value rests on several intersecting factors. The fixed supply structure we've already discussed, growing institutional adoption, increasing integration into regulated financial products, and its historical track record of recovery from drawdowns. Various research firms and analysts have offered long-term price projections ranging widely, with some pointing toward multiples of current prices over 5 to 10-year horizons. If those projections prove directionally correct, not necessarily the exact numbers, but the general trajectory, then 0.1 Bitcoin accumulated at today's prices would represent a meaningful gain over that period. But projections are not guarantees, and this is genuinely important to internalize. The case for caution is equally real. Bitcoin is still a volatile speculative asset. Its price has declined 50%, 70%, even 80% during prior bear markets, sometimes remaining depressed for years before recovering. Someone who invested at a market peak and needed to access their funds during a trough would have experienced significant losses. Unlike a dividend-paying stock or an interest-bearing bond, Bitcoin generates no cash flow. Its value depends entirely on what others are willing to pay for it in the future, which is a real limitation that serious critics of the asset class raise legitimately. There are also technological risks. While current quantum computing capabilities are nowhere near sufficient to threaten Bitcoin's cryptographic security, the long-term trajectory of that technology is uncertain. The Bitcoin protocol has mechanisms for upgrading, but upgrades require broad consensus and take time to implement, which creates a window of theoretical vulnerability if computing advances faster than expected. And there are regulatory risks. Governments around the world have taken varying approaches to cryptocurrency, from integration to restriction to outright prohibition in certain jurisdictions. A significant regulatory shift in major markets could affect the asset's accessibility and liquidity. None of this means Bitcoin is a poor choice for any given individual, but it does mean that any investment in Bitcoin should be made with eyes open, with money that represents a portion of a broader financial plan, not a desperation bet or a retirement strategy in isolation. The general educational principle that applies here is one that applies to all investing. Diversification and position sizing matter. No single asset, regardless of its track record or its narrative, should represent money you cannot afford to lose or money you'll need in the short term. We've been talking about 0.1 Bitcoin as a specific number, but it's worth stepping back and asking, what does a threshold like this actually represent? It's not a magic number. It doesn't unlock special privileges. It doesn't guarantee any particular outcome. No amount of Bitcoin makes you financially secure by itself. Financial security is a product of income, spending habits, debt management, emergency reserves, and long-term planning across many dimensions. What 0.1 Bitcoin represents is something more philosophical and in some ways more interesting. We live in a monetary environment where the supply of most national currencies increases continuously. Central banks create new currency to manage economic cycles. Government spending frequently exceeds revenue, with the gap filled by money creation. The historical result of this dynamic over long periods is that the purchasing power of money held in cash erodes. This isn't a political statement, it's a documented historical pattern across virtually every major economy. The dollar buys less than it did 20 years ago. The dollar 20 years from now will likely buy less than it does today. This is the nature of the system. Most traditional savings instruments, savings accounts, bonds, certain types of insurance products offer returns designed to preserve or modestly grow purchasing power in that environment. They're useful tools, but they operate within the same system they're trying to hedge. Bitcoin, whatever its risks and limitations, represents an asset class that exists outside that system's control. Its supply cannot be increased by any authority. No central bank can create more of it. No government can print it. Its rules are enforced mathematically by a distributed network, not by any institution. For some people, that characteristic, the sovereignty, the independence from monetary policy, is the primary value proposition, not the price appreciation, but the principle. Owning 0.1 Bitcoin is, in that sense, a statement about diversification beyond the traditional system, a small portion of one's savings positioned outside the conventional monetary framework, as a form of financial insurance against a system that has, historically, over long enough time horizons, eroded the savings of people who trusted it completely. Whether that insurance is worth the risks involved is a decision every person has to make for themselves, based on their own financial situation, risk tolerance, and time horizon. There is no universal answer, but understanding the principle clearly, understanding why some serious, thoughtful financial thinkers consider this kind of positioning worth having, is more valuable than any specific price target or projection. Let's bring this to a close in a practical way. If you followed this conversation and found it useful, the question isn't simply, should I buy Bitcoin? That's a decision only you can make in the context of your complete financial picture. The more useful questions are these. First, do you have your financial foundation in order? That means a stable income, an emergency fund covering several months of expenses, and high-interest debt either eliminated or under active management. Investment of any kind, in any asset, should come after that foundation is established, not before and not instead of. Second, are you making investment decisions based on clear thinking or based on psychological comfort? The principle of unit bias applies broadly. If you're being attracted to any asset primarily because you can own a lot of units, that's worth examining carefully. The number of units you own is not a proxy for quality, value, or future performance. Third, what is your actual time horizon? Short-term price movements in volatile asset classes are largely unpredictable and not particularly useful to focus on. The people who have historically done well with patient investment strategies are those who set an allocation, automated their contributions, and evaluated outcomes in years, not weeks. Fourth, are you comfortable with the risk? Not abstractly, but concretely. If an asset you hold declines 40% and stays there for 18 months, what happens to your financial situation? What happens to your emotional state? Can you hold, or would you be forced to sell? Honest answers to those questions should guide your position sizing more than any projection or forecast. If all of those questions resolve favorably, if your foundation is solid, you're thinking clearly, your time horizon is long, and you've sized your position to match your genuine risk tolerance, then building systematically toward a meaningful threshold like 0.1 Bitcoin is an educational exercise in long-term thinking that goes far beyond the asset itself. Here's where I want to leave you. There's a certain clarity that comes from understanding the financial system you're operating within. Its mechanics, its limitations, and its long-term patterns. Most people never develop that clarity because financial education is genuinely difficult to find in a form that's honest, accessible, and complete. The people who navigate money well over the long term share a few common characteristics. They think in years, not days. They understand the difference between speculation and patient accumulation. They've learned to recognize when their emotions are driving their decisions rather than their analysis. And they build habits, Small, consistent, unglamorous habits that compound quietly over time. Zero point 0.1 Bitcoin is one possible milestone within a much larger journey of financial awareness. It's not the destination. It's a marker, evidence that you can think clearly about money, make consistent decisions, and hold through the discomfort that any meaningful investment strategy inevitably involves. The most important investment you can make isn't in any particular asset. It's in your own understanding of how money works, how systems work, and how your own psychology influences the decisions you make with both. That understanding is what this channel is here to help you build. I'm AR. This is AR Investor. If this conversation was useful, share it with someone who's navigating these questions right now, and we'll see you in the next one. This video is for educational and informational purposes only. It does not constitute financial advice. All investment decisions carry risk, including the potential loss of principal. Please consult a qualified financial professional before making any investment decisions.